This sneaky little devil that I'm going to talk about is what is causing you to pay more at the gas pump, more for your favorite restaurant, and more for even your favorite seasonal Starbucks pumpkin spice latte. All this and more is happening because of inflation. In this video, we'll talk about what exactly is inflation, its impact on the economy, you and your money, and if you stay till the end, you can see what actions you can take to mitigate inflation. For those of you that are new, my name is Adi, and this is Financial Literacy with me, a channel where my goal is to break down complex financial concepts for the layperson so you no longer get taken advantage of by banks, financial advisors, scammers, though they might as well be one and the same, and plain ignorance in general. Let's start with an easy one. What is inflation? Inflation is the rise in the overall price of goods and services over a period of time. Simple enough? And what tends to cause this inflation that we speak of? Inflation is actually caused by an increase in the money supply used by the economy. So if a country prints more money than it actually needs, that causes inflation. And why is that? Well, think about it. If you have, say, $10 in an economy for 10 packets of chips, and then you pump in an additional $10, so now the economy has $20 for the same 10 packets of chips. Well, what do you think the business is going to do? Are they going to keep the same price for those packets of chips? Heck no. They're going to increase the price to match the increased supply of money in the economy. And voila, that's how you get inflation. While the cost of things do change over a period of time, not every price increase is inflation, but it is considered inflation when the price of many things increase over a period of time. For example, if the cost of oranges being exported from Florida went up due to an unseasonably low supply of oranges, or the price of parking at a sporting event went up, that's not really inflation, right? Because that's a one-off event and eventually the price will come back down. However, the situation that we're in right now, due to COVID, due to supply chain disruptions, and of course, due to the increased supply of money in the economy, that, my friends, is inflation. Now, extend that thinking a little bit. If inflation leads to a rise in the price of goods and services, what do you think happens to the money in your pocket, in your bank account, or under your bed? Well, logically speaking, if last year one packet of chips cost you $1, and this year the same packet of chips is going to cost you $1.25. So already you can see that it's going to cost you 25 cents more to buy the same good that you bought last year. Thus, logically speaking, the purchasing power of your currency falls. Let me put things into perspective. In 1933, $1 could buy you 10 bottles of beer. Today, you can barely get one cup of coffee from McDonald's for $1. In other words, due to inflation and the continuous haphazard money printing ideology of the central bank, the value of the US dollar has been decimated by almost 97% since 1900. Essentially, if you do leave your money in the bank, under your mattress, or in your bank account, or in your pocket, it's going to lose value. Not the physical value, because $1 is still going to be equal to $1, but its intrinsic value, which is why it's extremely important to try and make your money grow at least as close to the inflation rate as possible. For example, if by the end of 2022, average inflation comes out to about 8%, which is kind of what we're projecting it to land, at least in the US, that means that if you had $10,000 sitting in your bank since January of this year, that $10,000, while still equal to $10,000, is worth less. What I mean is it will be able to only buy $90 to $100 worth of goods and services on average. And that is why I am so bullish about cryptocurrency and blockchain, because I really think it's going to upend the entire financial system. But that's for another time. You can skip this part if you aren't really interested in hearing how inflation is measured, and jump ahead to see what the effects of inflation are on you and your money. So inflation is measured by this thing that we call CPI, or the Consumer Price Index. So CPI basically measures the change in price of a basket of goods and services over a period of time. What do I mean by a basket of goods and services? Now, essentially, to get a good handle on, number one, if there is inflation, and number two, what is it, you need to sort of get a sense of what is the general price increase of a number of goods and services. Now, you can't just look at the price of oranges, or what you're paying at the gas station, or their increase in price as inflation. No, you can't. So in the case of the US, the basket of goods and services consists of about 93,000 items that the US deems is representative of what a typical household spends their money on. So for example, if the price of that basket of goods and services goes up by, say, 5% in a period of a year, then yes, the US will say that inflation is at around 5%. And also, just a minor point, inflation is a lagging indicator. What I mean by that is inflation, it's already happened. It's not something that's forecasted for the future. So currently, per the US Labor Department, the current annual inflation from August 2021 to September 2022 is 8.2%. And this was announced on October 10th. The next inflation update will be on November 10th and will be for the 12-month period that ends on October 2022. Now, we already know that high inflation is bad, bad, bad. But exactly how bad is inflation when left unchecked? The economic cost of letting inflation run rampant is extremely high and could even derail an economy. I mean, unless you've been living under a rock, you've been hearing talks of a potential recession next year. Now, it is the Federal Reserve's duty to keep inflation in check. Now, you might be asking, what is the Federal Reserve? So the Federal Reserve is just a fancy name for the Central Bank of the United States of America. They probably didn't name it the Central Bank of the US because they probably didn't want a money high situation. Now, while it's the Federal Reserve's goal to keep inflation in check, it's not always an easy thing to do. Partly because inflation is sort of a self-fulfilling prophecy. Now, let's think through this. If there is inflation, the price of goods and services are high up. And obviously, a typical consumer like you and I goes to your boss, asks them for a raise. And imagine all those other people in the economy are also doing the same. Now, guess what? You've got people that have more money in their pockets. Subsequently, businesses start to increase prices as well because of two things. Number one, increased demand, but also because now they have to pay their own employees more money. So it is this sort of self-fulfilling prophecy that there is no end to inflation if left unchecked. Now, the bad of this is, while it's great for the business, it's bad for the consumers because this wage price spiral could actually, in turn, if left unchecked, could actually derail the economy, thereby leading to a recession. Now, in the US, in general, the Fed tries to maintain a 2% annual inflation rate, which they have determined is most compatible with their mandate to promote stable prices and maximum employment. So, what can you actually do when it comes to managing your money in a high inflation environment? So there are a couple of things. Number one, be wary about interest on any new loan that you take. Number two, this is a great time for people that are risk averse and love saving. And then number three, do not be afraid of the volatility in the stock market. All right, let's talk about number one. Be wary about interest rates on all loans that you have. That new credit card, that new car loan, or worse, that new house loan that you've taken, you're going to get locked into a high interest rate for the next 30 years. If you can avoid it, try borrowing less and try and pay off higher interest debt faster, especially when it comes to credit cards. Now, these credit cards are sneaky little buggers that have really, really high interest rates, typically double digits. You should try and pay off your loans in descending order of interest rates. So pay off the higher interest rate loan first and then just work down. Don't be afraid to look out for other offers, either balance transfer offers or new account opening offers in other banks, be it brick and mortar banks or even digital or neobanks as they're called. Some of these banks use this period to try and acquire new customers and sometimes have pretty interesting either cashback offers or 0% interest offers, especially when it comes to things like a balance transfer credit card. Obviously, the trick is whatever offer that you take, try and make sure that you pay off the money before the introductory period ends. Now, what if you're looking for a house in this environment? Well, I'm going to do a video about how and whether it makes sense to rent or buy, and if you do end up buying, how do you actually evaluate a real estate deal? But for now, if you're looking for a house in this high interest rate environment, be wary. If you can afford to, sit on the sidelines if it's not a necessity. Because today, the mortgage rate in the US, for example, is close to 7.2, 7.3%, levels that haven't been seen since 2008. Now, you really don't want to get stuck with a 30-year massive loan at such a high interest rate. Yeah, of course, people are going to say that, look, you can always refinance later, but keep in mind the way these mortgage payments work. When you take a mortgage, in the beginning, you owe more interest because your loan balance is still high. So most of your monthly payments initially goes to paying the interest and only a little bit goes to paying off the principal. Number two, this is a great period for savers. I'm not a big proponent of saving, but yes, this is a great time to actually build out your savings fund or your emergency fund. Typically, I'd like to say you need to have about 3 to 6 months of funds that will keep you afloat in case of an emergency. In today's environment, interest rates on savings accounts, fixed deposits, certificates of CDs, certificate of deposits are high and rising because of the central bank's interest rate hikes, which essentially means greater earnings and greater cash back in your wallet. You should also be very strategic about where you're putting this money. Definitely don't leave it in your bank account and do not leave it under the mattress because you're not going to make anything out of it. The third thing is investing in the stock market. Again, I'm not going to get into how you need to invest because that obviously has to be a whole another video. But right now, for the ones that do understand and do want to invest and are confused whether they should wait, I will say this: because of the volatility in the stock market, don't wait to invest. Time in the market trumps timing the market. Yeah, there will likely be more downward pressure over the next couple of months, but some of your favorite stocks or companies that you use products of, so this is a great time to go bargain hunting in the stock market. Do not let the Fed's decision to keep increasing interest rates steer you away from potential long-term investments that will eventually build financial wealth, leading to financial freedom and financial independence. Thanks for watching. If you like this, I'd urge you to like and subscribe and stay tuned because I'm going to be doing a lot more of these kinds of videos where I break down complex financial concepts so that the lay person can actually understand what the heck is going on and aren't turned away by all this hoopla that's going on around them. Stay tuned and stay lit.